Welcome to Unit 2, lecture looking at financial analysis in general. Having spent the first lecture going in, I'm sure, what seemed like excruciating detail about financial reporting, now we're going to shift to the main focus of this course and start talking about financial analysis, at least in broad terms, before getting into some of the very specific aspects of financial analysis in the succeeding units. We're going to answer some very basic questions here. What is financial analysis? And what does it mean for state and local governments? Who is it that analyzes government finances, and why the heck would they want to do so? And then, lastly, how is the financial health of governments measured? What are some of the basic analytical techniques that are applied that span all the different types of aspects that we're going to look at in the coming weeks, like financial position and solvency and revenue analysis, expenditure analysis, expense analysis, debt analysis. There are certain types of analytical techniques that are used in all of them. So what is financial analysis? One definition that I adapted from Investopedia.com, the process of evaluating entities to determine their suitability for investment. Typically, financial analysis is used to analyze whether an entity is stable, solvent, liquid, or profitable enough to be invested in. One of the most common ways of analyzing financial data is to calculate ratios from the data to compare against those of other entities or against the entity's own historical performance. Another definition adapted from businessdictionary.com, financial analysis is the assessment of the 1. Effectiveness with which funds, investment, and debt are employed in an entity, 2. Efficiency and probability of its operations, and 3. Value and safety of debtors' claims against the entity's assets. It employs techniques such as funds flow analysis and financial ratios to understand the problems and opportunities inherent in an investment or financing decision. A couple of other definitions I've run across, and I'm somewhat paraphrasing here. The examination of financial and non-financial information about an entity for the purpose of informing decisions and drawing conclusions. Taking raw data and converting it into a form that can serve as the basis for evaluating an entity's financial health. I think you look at these and you can see that there are some common themes. One is the calculation of ratios. The obtaining of information from financial statements and a variety of other sources and comparing them to one another in the form of a ratio, a calculation that produces a number that then can be compared with other entities so that you have a context for understanding what those numbers mean. If you calculate a ratio and it comes out to 1, what does that mean? What is 1 good? Is 1 bad? It's hard to tell unless there's some rule of thumb out there that you can compare it to. But most often what you're going to do is you're going to look at other similar entities and say, well, did they get a 1? Or did they get a 0.5 or a 1.5? And is it better or worse to be higher or lower than what my peers got? The other thing you're going to do is you're going to track it historically. I'm at 1 now, but was I at 0.5 in the past? Was I at 1.5? So am I improving? Am I declining over time? It's not just important where I am now, but how I got here and where I'm heading. And it's the where I'm heading that is the thing that people mostly care about. Some financial analysis is purely historical and informative. I want to look at how things got to where they are now. But for the most part, that looking at how things got to where they are now is meant to be the basis for guessing where they're going to be going in the future. How healthy is that government going to be going forward? And that's because much financial analysis is meant to support decision making. People have a decision to make. Are they going to buy bonds? Who are they going to vote for in the election? Where are they going to live? Where are they going to work? How should scarce resources be allocated in the budget? Should tax rates be raised or should they be lowered? Can the government afford the amount of debt it's got outstanding? These are decisions and conclusions that people every day are trying to arrive at, and financial analysis supports that decision making, that conclusion drawing. And then those definitions are full of terms that identify key aspects of financial health: profitability, solvency, stability, liquidity, efficiency, problems, opportunities, threats. It's a variety of terms that are meant to identify the key things that explain whether a government is in good or bad financial health. So who is it that is doing these analyses and trying to answer these questions? If you look at those first couple of definitions, they come from investor-related websites and private sector-oriented investor websites, and so there's a lot of focus, obviously, on what am I going to get back if I invest money in this entity, and on the governmental side, what we're talking about here is buying municipal debt. If I buy a government's bonds, or I'm a bank and I lend it money, are they going to pay me back? If there's some risk that they're not, how much should I charge them to make me feel comfortable with the level of risk of default, not paying back those bonds? That's certainly a big part of it, and among the most intensive users of governmental financial statements are people with this type of a concern. People who are buying bonds, lending money to a government, or thinking about doing it, and want to know whether that government is in a position to repay it. There are some broader concerns as well, and if you look at GASB concept statement number 1, objectives of financial reporting, it lists a number of things that are of greater concern beyond just looking at whether a government can repay its debt. Governments essentially confiscate much of their revenue, especially general purpose governments like states and counties and cities. They get their money mostly through taxes, and we really don't have much choice as to whether to pay those taxes. If we do the things that are taxed, earn income, purchase things at stores, own property, we're going to be taxed, and we're required to pay those taxes. So there's a burden on the government to demonstrate that it has been accountable, that it's been a good steward over that money, that it has been financially responsible, that it's spent the tax dollars in the way that the providers of the resources want them to, the way that citizens want them to, a way in which the needs of the citizenry are being met. But all of this is full of subjective terminology. Appropriate, reasonable, effective, efficient. Who defines that? Well, it's defined differently depending upon who you ask, and a big part of financial analysis is, I think, establishing your parameters and defining terms like appropriate, like reasonable, like effective and efficient, so that when you calculate ratios, you do your analysis, there's some scale against which you're comparing it, and you're saying, appropriate means this. It means performance at a level above this, and that's an important part of communicating your financial analysis, and in a way that other people can read it and understand it and draw meaning from it as well. Accountability. Governments are not just accountable for how they're using their tax dollars, but for living within the variety of laws and regulations that govern how they raise money, how they use that money. Are they, and not just are they accountable for the money they raise, but are they accountable for meeting the needs that have been communicated to them? Are they accountable to the people and organizations for whom they act as a fiduciary, such as their employees and the money that is in their pension fund or their retiree health insurance fund? Now, the people who are doing this analysis, vary, and some do it a lot, some don't do it very often, some don't do it at all, but are would be considered potential users of information and potential financial analysts. Clearly, the ones who are using this information most often on a daily basis to make decisions are people working in the municipal bond industry. Those are the people who are concerned about those issues of whether the government's going to be able to repay its debt. There are, rating agencies that are assessing credit worthiness. That meaning, a government's likelihood that it's going to be able to repay its debt. There are mutual funds that are buying this debt on behalf of their participating investors. Insurance companies are enormous holders of municipal debt because it's a very predictable income source, money that they know they're going to have in place when insurance claims need to be paid. Banks and underwriters and other people who are involved in issuing bonds or lending money, have analysis to do to decide how much they're going to charge for those services and what interest rate the government ought to be proposing to sell its debt for. There are a variety of legislative oversight and regulatory bodies in government. Every government has some kind of operating or governing body. The state legislature, the city council, the village board, the county board of supervisors. For something that's more like a business type activity, it's going to have a board of governors or a board of trustees or something like that. They are users of financial information, and the degree to which they are what the accounting standards would consider to be a true user, meaning someone who doesn't have access directly to the accounting information and is reliant upon the government reporting the information in order to get it, varies from government to government depending upon the structure. In a government that's a strong mayor, strong executive, like a state government, every state has a governor with significant powers. Texas, not so much. It's the lieutenant governor in Texas who really has the most power. But for the most part, there's that executive at the top, and the legislature, is a separate body and doesn't have direct access to the accounting information, and so they're users. And that's the way a lot of city councils and county boards are set up. There's an executive or a mayor who's very strong and proposes the budget himself or herself and has control of the accounting information, and the legislative body is dependent upon external reporting to get some information. They don't have direct access to the accounting system. But that's not always the case. In city manager type governments, the city council is hires the city manager, and so they in fact do have direct access to it. And so they traditionally aren't what would be considered to be users, but all of them have decisions they need to make that use this information. They're allocating resources among programs, trying to decide whether a program ought to be expanded or cut back. If they've got a budgetary crisis and they need to cut spending somewhere, they're going to need information about that. To inform their decisions about whether they can raise taxes anymore or whether they can afford to issue debt to do road construction or replace sewer mains or to build a new school. They all need information to make those kinds of decisions. The federal and state government has a number of regulatory boards and agencies that are monitoring finances or controlling particular types of activities, and they need information as well. The Federal Highway Administration, the Federal Department of Education, the Health and Human Services. They all provide a considerable amount of money to state and local governments, and they demand an accounting. They want information back to show how that money was used and that it was used appropriately. As we will talk about in a later unit, it's Unit 11 or 12, something like that, where we look at government-based fiscal monitoring. There are a number of oversight bodies that either are closely monitoring the finances of other governments or actually in control of the finances of those governments, and they need information as well, and they need to analyze finances in order to do their jobs. And then the broadest group, the citizens and the taxpayers. There are taxpayer groups, citizen research organizations. I used to work for a group called the Citizens Budget Commission in New York City that did applied policy research focusing on New York City and New York State, trying to hold those two governments' feet to the fire to make sure that they were spending money wisely, staying healthy going forward on a fiscally sustainable path. And then even individuals, gadflies, they're often referred to, people who always show up at that city council meeting and are always ready to testify and are keeping close tabs on things. Um, most citizens don't, you know, ever open up a financial report of a government. But all of us are potential users, whether we've done it or not. Even those of us who work at the Governmental Accounting Standards Board, or who are on a path to become CPAs, may look at these things for work, but never ever actually get around to looking at them, for their own village, the school district their kids go to. Um, I was working and living in New York City for a long time, and so I was seeing the financial statements of the city I lived in. But it was a few years after I moved into the suburbs before I actually got around to asking to see the financials of my village and of my school district. Um, the media certainly will pay attention to this stuff, and that's one way that citizens and taxpayers hear about financial information. Academics and researchers are conducting studies, looking at information, sometimes to inform decisions, sometimes just for the sake of doing the analysis and understanding things that happened in the past. And that brings up a key thing to understand when you're looking at the users of financial information, which is to distinguish between the end users and the intermediaries. Like citizens are end users. They're people who need information and are using governmental financial information, whether they realize it or not. If they're looking for a place to live and they're looking at the tax rates as they're considering buying houses, they're using governmental financial information to make a decision. But they often are not going to find that information in the financial report themselves. Somebody else is going to draw that information out. Reporters or a taxpayer association, analysts and a mutual fund, transmitting that information to the individual participating investors in the fund so that they can make decisions of their own about what to invest in. Those are people who are actually directly accessing the information and then analyzing it, doing financial analysis, and then communicating that information on to other people who need it in order to make decisions of their own. As we will see, going unit to unit through this semester, there are a variety of key factors. If reading an analyst guide to government financial statements, you'll see that there are distinctions made between short-term and long-term focus, short-term liquidity, still short-term but maybe a little bit broader, budgetary view, usually looking over the next year, and then longer-term views, looking at issues like solvency, whether the government is going to be able to meet its obligations financially going forward into the future, whether how highly leveraged it is, how much it is relied on borrowing in order to obtain the assets it has for providing services, coverage, the ability to make debt service payments on liabilities when they come due. And then this broad issue of risk, what things might happen that could put the government in a difficult financial situation. These are the kinds of things that we are going to explore over the course of the semester. And one thing that we will find is that although each of them may have their own specific ratios, there are certain financial analysis techniques that are common to all of them. The primary one of those being trend analysis, looking at a governmental entity over an extended period of time. Because it's important to know not just where we are now, but how we got here. How quickly did we get here? How have things changed? How fast has it changed? Are things increasing or decreasing, getting better or getting worse? That sets your analysis in an historical context and gives you some basis for looking forward and contemplating where the government is headed. One thing you need to be careful about, and this will come up frequently during the course, is that it's not always clear when you're looking at trends when major changes have taken place. Sometimes it is. You'll look at a trend, maybe graphed out in a line chart, and halfway through the trend, that line jumps up or it plummets, and you realize, wow, something big must have happened there. But it's not always evident, especially if you're looking at highly aggregated numbers and there were significant changes within that, but there are other changes that compensate for it, and so you don't really see or know that something significant has changed in there that you ought to be aware of and that's important to your analysis. And that's why the financial reporting standards require in a number of cases that governments provide some kinds of explanations. The statistical section standard statement 44 requires that governments identify these types of changes that affect trends that might not be evident when you're eyeballing them on your own, or if you're not privy to what's been happening during that period the way you would be if you were a finance officer or working on the staff of the city council. Another issue is how long that trend ought to be. 10 years is very common. But if you're in the municipal bond industry, generally what they're looking at is the past 5 years, or the past 3 to 5 years. There are pros and cons to a shorter or a longer period. Consider the fact that governments have been struggling the last several years since the recession began in 2008. And so if you were just to look at the last 5 years, it would look like a very difficult 5 years. And if you were trying to look forward, well, how are things going to proceed over the next 5 years? Looking at those particularly bad 5 years might lead you to make conclusions that, undershoot the mark. Chances are the next 5 years are not going to be as bad as the last 5 years were for governments. And so it might behoove you to look at a longer period of time, to look at the last 10 years, so you can see what that period was like leading up to that, so that you can make some conclusions. Maybe they're not going to perform the way they did before 2008, and there are a lot of people who believe that some fundamental changes have happened that mean they're not going to ever return to those pre-2008 levels. But you at least understand that when you're not in a terrible recession, certain things do change, and grow over time. Revenues, don't decline or grow in a healthy way, and not just in tiny little increments, and that will help to inform what you're looking at going forward. Of course, the further you go back in history, the greater there is the chance that there were these major changes that resulted in significant shifts in trends. So you always have to be very careful about that. The other great analytical tool that extends pretty much across the board, in addition to trend analysis, is peer analysis, making comparisons with similar entities to the one that you're interested in. So am I keeping up with the Joneses? Is the grass greener on the other side of the fence? That helps you to understand, whether you're in line with other similar governments or trailing them or leading them. And your comparisons might be based on location. You're looking at a village, and so you look at all the other villages in that county, or all the other villages in the state, all the other counties in the state, all the other school districts. Maybe if it's a big city, you're looking at other major cities around the country with which you believe your city is a competitor. Certainly type. You're not generally going to compare a state to a county. You're going to compare states to other states, school districts to other school districts, water and sewer utilities to other water and sewer utilities. And another key characteristic that is going to define that peer group is size, either population or revenue. You can make comparisons between a small village and a large city, but a large city is probably responsible for a lot of things that a small village isn't, and its revenue options are probably broader, and so it's harder to think that those comparisons might be meaningful, or at least not as meaningful as if you were comparing entities of similar size. So if you're looking at cities, you might look at cities between 50,000 and 100,000 in population, or between 10 and 15 million dollars in annual revenue, something like that, to ensure that these really are peers that you're comparing against, really are comparable, similar governments. The method of analysis often involves, calculating averages, means, or medians for that peer group and saying, are you above or below that? Sometimes, and we'll see this when we look at some of the systems of financial analysis like Ken Brown's 10-point test, where you're looking at quartiles. Are you in the bottom 25%, in that middle 50, above and below the median, or in the top 25%? That gives you a sense of not just whether you're above and below your peers, but how far above and below your peers you are. Common size ratios, percentage change and percentage distribution, are used to examine just about every key factor of financial analysis. Common size ratios are exactly what their title suggests they are. You're taking entities of different sizes and pulling them into a common metric in a way that they can be compared. So if you do want to look at governments of vastly different size and draw some conclusions from that, you need to set them in a context in which they are actually comparable, because if you're looking at a government that's got $1 billion in revenue and you want to compare it to one that has $1 million in revenue, well, there's a pretty significant difference in size there. And if the large government's revenue goes up by $1 million, that's a drop in the bucket, but that's a doubling of the revenue of the smaller government. So you need to create these common size ratios in order to be able to compare governments of such disparate size. Percentage distribution is a ratio that shows you how much of the total a particular item represents. For example, how much of a city's revenue comes from its property tax, or how much of the state's budget goes to paying off its outstanding bonds, its debt service expenditures. It's calculated by dividing that individual item amount, like the property tax revenue, by the total of the relevant category, like property tax revenue divided by total revenue. So let's look at an example. There's a state that passes a law and it takes back a 0.25% sales tax that it had previously given to local governments. And two governments, Government A and Government B, both lost money because of this. Government A lost $12 million, Government B lost $7 million. So who did this affect worse? Well, if you just look at those dollar amounts, Government A lost $12 million, which is more than the $7 million that Government B lost. But they're obviously of different sizes. Government A has almost 3 times as much annual revenue as Government B. So you need to look at percentage distribution to get a sense of magnitude of which of these was really affected the most. Again, you're looking at the individual amount, the amount lost in this case, divided by the total amount, total revenues. So for Government A, 12 million divided by 156 million is 7.69%. So it lost almost 8% of its revenue. Calculate the same ratio for Government B, 7 million divided by 58 million. Well, it's actually a bigger deal for Government B, even though the nominal amount, the 12 million versus the 7 million, made it look smaller. As a percentage of its total revenue, it actually lost more. It lost 12% of its revenue because of this action by the state government. So to answer the question, which government was affected worse, all other things being equal, this percentage distribution suggests that Government B was affected worse. Percentage change, the other common size ratio, shows how much something has changed, the magnitude of that change from one period to the next. For example, how much did a city's property tax revenue increase or decrease from last year to this year? Or how much did a state's Medicaid costs rise or fall? Almost certainly rose during the 2000s. That's the kind of question you can answer with percentage change, which you calculate by taking the most recent year amount, subtracting the earlier year amount, and then dividing the result by the earlier year amount. So for example, you have 2 school districts, both with growing student populations, but they're both very different. District B has started with 20,000 students, which is 4 times as many as the 5,000 students that District A started out with. So which one grew more? Well, District B grew by 4,000. District A grew by 1,000. So on the face of things, it seems like District B grew, but you need to take into context where they started from, what base that growth uh, took place on. Again, more recent amount minus earlier amount divided by the earlier amount. So for District A, 6,000 minus 5,000 divided by 5,000 gives you 20%. Enrollment grew 20% from 5,000 to 6,000. Look at District B, where the student population grew by 4,000. 24,000 minus 20,000 divided by 20,000 equals 20%. They actually grew at the same pace. Even though District B's growth was 4,000 as compared to 1,000 for District A, considering the bases that they started from, they actually both grew at the same pace. And that's the end of this lecture. Much shorter than the first one, I'm sure, to your great relief. What are the takeaways here? Financial analysis can vary from person to person. It depends upon what their interest is. They're interested in if a government can repay its debt, or what it's doing with your tax dollars. Has it been efficient and effective? Is it living within its means? Is it obeying the laws and regulations that govern its finances? Financial analysis can serve all of those needs, and what you particularly focus on will depend upon what your needs and your interests are. And we saw that there are a variety of different kinds of people who benefit from financial analysis for a variety of different reasons. And we also saw that there are some common techniques that we're going to be using over and over and over again in each of these units, even though we're looking at different issues like debt analysis or revenue analysis or financial position. Percentage change and percentage distribution are valuable in all of those. And with that, that's the end of the lecture. Thank you.